Welcome everyone to another live stream. I had so much fun doing it last time yesterday, so I thought it'd be a great time to do another live stream. So I'm just waiting for everyone to join the stream, waiting to get some more viewers in because we just started here. It's got 120 viewers at the moment. I think last live stream we got that up to around 1,600, so hopefully we can beat that this time. I'm just going to try see if I can bring up the chat here. Just 1 second. Bear with me while I do this. Let's see here. Okay. Got it here. Awesome. So how's everyone doing today? It's really good to be able to engage with you guys in real time. Lori Lightfoot is out of Chicago. Yeah, that's good. I thought that was quite funny what happened there. It's a good win for Chicago because crime was just getting out of control. Hello, people checking in from UK. David, yes, I'll go over the UK food crisis. All right. So yeah, we got a lot to cover in today's video. We've got issues with what's going on. I'll quickly give a commentary first on what happened in the markets today. Not much. Then we'll go over something that's happening with Pakistan. That's going to be huge. They're also risking default. But the biggest story, which I'll go over in a moment, is what's happening with Blackstone. And they just defaulted on one of their commercial mortgage-backed securities. And this is something I've been talking about for a while now. It's going to be a huge risk for the markets. And it could potentially be the next global financial crisis. So I won't get into that first. I'm going to wait until we hit peak viewers to go over a couple of stories first. But that's definitely a huge story. I'll also cover a bit what's happening in the Australian housing market. I'll go over what's happening with the UK food crisis and inflation in Europe. And then we'll also go over a bit on China's demographic collapse. Hopefully my voice holds up today. I'm still battling a bit of a cold, still not 100%, but the show must go on, everyone. So again, we'll just wait for some more people to drop in. Hello. Welcome, everyone that's just joining right now. Brisbane here. Number Horse. Atlantic City. Oklahoma. New Zealand. That's great. But we all have like-minded individuals around the world. Shows we're not too different after all. Oregon. Indiana. Okay. Awesome. All right. Well, let's get into the show, everyone. So first things first, we'll quickly cover what happened in the markets today. So there was a bit of a mixed bag what happened in the markets today. They started off a bit bearish at the start of the day, but then we had a rally towards the end of the day, and the markets were hitting a very critical 200-day moving average. If it closes below that, that's bearish. If it closes above that, that's bullish. Now, the reason why the market rallied was more just algorithms and very silly reasons. So let's get into that now. Just quickly, what happened today. So Bostic batters stock bears, but bond yields soar after record inflation. So we got news from Europe that inflation is actually still worse than expected, which no surprise for us, but the markets seem to be too optimistic on what's happening with inflation. And also there's strong economic data, which is meaning there's going to be more rate hikes. So strong US labor data claims dropped and unit labor costs rose. So that is bullish for the jobs market. So again, there's more room for the Fed to tighten. Combined with record high core European inflation, which I'll get into more in depth in a moment. But core is just pretty much when you exclude food and energy. And the funny thing they say is, well, we exclude food and energy because it's so volatile. Well, yes, it can be volatile, but it's normally volatile going up. So it's still in an uptrend. So while the Dow was holding up overnight thanks to Salesforce gains, that was another big reason why the Dow Jones had a gain, because Salesforce went up 11%. The S&P and NASDAQ both opened below the 200 moving day average, like I said, is very bearish. So the algorithms went to work to lift it above. Some people call that the plunge protection team. So then they went about sideways. But this is the reason why the markets rallied today. Was Bostic Fed said, and this was a title Bloomberg put out, that the Fed could be in position to pause by mid to late summer. Now, the thing, well, we don't really have to pay too much attention to this, is because he's not a voting member on the Federal Reserve. We've had 3 people who are voters on the Fed's chairs, and he has no say in it whatsoever. So we've had 3 people come out that are going to be voting on whether to go 25 or 50, and they're more towards the 50 basis point hikes. And this guy's obviously just come out here, tried to get some clout, get some clickbait titles there. And he's saying, okay, no, or this is what Bloomberg said. He's in more favor of going 25, but when we go a bit deeper, he's still saying there's going to be more rate hikes coming. So it says here that's quite idiotic because that's not a pivot and it's already priced in. So we all know, or the markets think, that the Fed is going to pause by late summer, which I don't think they will. I think they're going to go 6%. But this is what he actually said. Bostic Fed says they still have ways to go in raising rates, and says higher rate endpoint could be needed if economy shows more strength. Well, we just got that jobs market data. So that was the reason why the market had a slight rally there, because the algorithms are just trading, okay, maybe there won't be 50 base point hikes, maybe just be 25. But again, the more important picture is are they going in not 50 now? It's more important of where will they end up. They could do 50 now, but then if they stop at 5.5%, that wouldn't be as bad if they do 25 basis points and then inflation continues to come in hot and then they have to go to 6 or 7%. And that's actually more worse where they end up, not how quick they get there. Again, 50, 25, I think they should do 50, but it really doesn't matter. What really matters more is the end game. So that's why the market's had a bit of a gain today. Gold, silver was pretty much flat, but now we've got the 10-year US Treasury holding over 4%. So that's going to be more competition for stocks, the bond market. But let's head now into our first story. That was just market commentary for today. Let's head into our first story, what's going on with Pakistan. So going now. So markets brace for Pakistan default risk as 7 billion debt looms. Now this is quite funny. Pakistan is just getting in a worse and worse situation, and I don't know who would want to loan Pakistan $7 billion because we all know they're not going to be able to pay it back. It's kind of like a family member. You give them a bit of money to help them out. They go and spend that money straight away. Then they come and ask for another loan. You go, well, look, you haven't really paid back the last loan, but okay, I'll give you one more loan. You give them another loan. They go and spend that. Then they come and ask again. And you're like, well, you haven't paid me back the first loan. Okay, one more time. You give them the third loan. They spend that and come back and ask again. We all know by now that Pakistan is in a very, very tough situation, and they're not going to be able to pay back their debt. And the unfortunate thing is, we live in a world where we want there to be no consequences. Nobody can get hurt. Everybody's a winner. We can't have any economic pain. Well, we've had prosperity, I think, for the past 3-4 decades, but we've been kicking the can down the road, and eventually we're going to have to face that pain. And we're seeing a lot of developing countries facing that pain now, but it's only a matter of time before we face that pain with inflation. And really, the middle class is facing that pain right now. So bondholders are bracing for a potential default by Pakistan as the nation struggles to meet billions of dollars in debt repayments by June. So that's right. So June is a key date to watch here for the emerging markets. The nation's dollar bonds due next year slid to the lowest since November on Thursday as investors weigh its ability to honor its $7 billion repayments coming in months, including a Chinese loan of $2 billion due in March, according to Fitch Ratings, and the rupee slumped 5% to $280 per barrel. So if you thought that the rupee couldn't slump anymore, it just has. And I'll get into in a moment in this story, we're seeing more and more predatory loans from China to these developing countries in order to take some of their land, take some of their strategic ports, strategic infrastructure, and China is going to be increasing these loans yet again. So Pakistan was downgraded deeper into junk by Moody's Investors Service this week as the country faces its worst economic crisis in decades. Well, they think if they weren't junk already, well, now they're trash. With foreign reserves plummeting and inflation soaring to record high, authorities in Pakistan are relying on a bailout loan from the IMF to stave off a default which has remained elusive. So again, this is something they've been banking on, is getting a loan from the IMF. Now, remember, a lot of us developed nations, a lot of central banks like the US, China, Europe, etc., the ECB, they send money to the IMF to fund out these, to bail out these poorer countries. So really, this is our money that's going to be going to Pakistan. But it looks like the IMF might know that they're not going to get their money back, and it'll be very interesting to see if they do come in last minute to save the day or not. So they said there's definitely a high risk for a default as negotiations with the fund keep getting drawn out longer than expected, while reserves continue to dwindle to precautious levels. So we can see here default fear. Pakistan bonds due next year decline on rising default worries. So what happens with bonds, as people don't think they're going to get their money back, what they do is sell them, and they sell them for a discount. If you hold it for maturity and they don't default, you get your money back. But a lot of investors don't think that, and they're selling their bonds for pennies on the dollar. So Pakistan's 8.25% bond due April next year dropped 1.4 cents lower to 51.62 cents on the dollar, down from a third straight day. The nation's external financing needs are estimated to be around 11 billion for the fiscal year ending June. So that's right, they need 11 billion. I think there's absolutely no way they're going to get this money, everyone, and I think a default is inevitable. Including 7 billion in external debt payments, Moody said in a note Wednesday. And they say here, in the current extremely fragile balance of payment situation, disbursements may not be secured in time to avoid a default. Moody's Analytics, led by Grace Lim, said in a statement on Thursday when the firm cut Pakistan's credit rating to CAA3. Now, this is where China comes in. So China's coming here to save the day. So meanwhile, Pakistan got a 700 million loan facility from China Development Bank in February. And he said that China is open to participating in multilateral efforts to help heavily indebted nations in a constructive manner, China's Central Television reported. So again, we're seeing more and more of these predatory loans. This is happening in the Pacific as well, with a lot of Pacific nations. We're seeing a lot of leaders in these poorer countries. They're selling out to China. They're selling their countries off to China to get some money. They're probably getting a kickback themselves. And this simply is going to mean that China's going to get more and more power. And I think, China, if they don't get their money back, they're going to take, again, some land, some strategic ports, or some strategic infrastructure. They said the Western-led commercial creditors and multilateral financial institutions are the basic creditors for developing countries. So China calls for a concerted effort of all parties to play a constructive role on the economic and social developments of Pakistan. So again, they don't want to lose money on the efforts. So now they're calling for the West to bail them out as well. And Pakistan Prime Minister said this week an agreement with the IMF could be reached within the next few days. So we'll have to see what happens there, everyone. So this is very bad news for Pakistan. This is could have domino effects on the developing markets, because a lot of these banks, they're going to have bonds on their portfolios. A lot of these hedge funds will have these bonds on their portfolios, and it's going to have domino effects. When one country goes down, with the way the whole global economy is interconnected now, it has ripple effects across the border markets, because somebody's lent Pakistan that money and they're not going to be getting their money back. So what do you guys think about that? I'm just going to read the chat for a second before we get into our main story, what you're all here for, Blackstone defaulting on one of their commercial mortgage-backed securities, which is going to lead to some big issues. So Queen Bee likes live streams. Can you do it? Yeah, I'll continue to do it. I don't know if I'll do it every day or how long I'll do it, but I enjoy it as well. See if I can figure out a way to bring your comments on screen here. Someone said they're going to raid all our food supplies. Let's have a look here. Okay. Yep. It's good to see you guys chatting in the chat there. All right. Let's get into our main story now. So I've been covering this last week. I did a video on this, how there was a huge hedge fund that defaulted on a $1.7 billion mortgage-backed security, commercial mortgage-backed security. And in 2008, we had the residential subprime mortgage crisis. Well, I think in 2023, we could be facing another mortgage crisis, but this is actually going to be in the commercial real estate sector. Now, the reason for this is because, like what happened in 2008, when people had these balloon payments or they had these adjustable rate mortgages, a lot of commercial real estate investors took on these adjustable rate mortgages. They took advantage of record low mortgage rates during 2020 when they were at zero. And now mortgage rates are skyrocketing. So unlike in the US where they have 30-year fixed rate mortgages for residential, in the commercial real estate sector, a lot of these investors took these adjustable mortgage rates and now they're severely paying the price. And this is just the beginning, everyone. Every day now, when I'm checking the news, I'm seeing another hedge fund or another landlord has defaulted on one of these commercial mortgage-backed securities because these properties have huge vacancies. They're losing value. So a lot of these landlords may think, look, maybe it's just better for me to walk away. And they're saying, like I said, if you owe the bank $1 million, that's your problem. But if you owe the bank over $1 billion, well, now it's the bank's problem. So look at this, everyone. Blackstone defaults on Nordic CMBC as property values wobbles. So that's right, everyone. So it says here, BlackRock Inc. defaulted on a $531 million, that's $562 US bond backed by a portfolio of Finnish offices and stores as rising interest rates hits Europe and property values. Now, again, I'll get into a moment. This is talking about one of their portfolios in Europe, but this is happening across the whole world. It's happening in the US. I just did a story on that last week. I'll show you a few other developers or hedge funds in the US that are defaulting right now. This is going to happen across the whole world. And again, I think this could be the beginning of a new financial crisis. It's not me being exaggerated, being alarmist. This is just the facts, what's happening right now. But of course, most people don't know what's going on in the commercial real estate sector. They focus on the residential sector, but most, average Joes and Janes, they don't know what's going on with commercial real estate. So Blackstone, which acquired a landlord, Spoda Oy, I think that's how you pronounce it. This is Finnish real estate. In 2018, sought an extension from holders of securitized notes to dispose of assets and repay the debt. According to people with knowledge of the plan, bondholders voted against a further extension, the people said, asking not to be identified as the sales process was not public. So you're seeing here these investors, these bond investors, they want their money and they want their money now because they know the situation is going to get worse. Blackstone tried to ask for an extension, but they said, no, we want our money now. And they also don't want this to be very public. This was kind of leaked out to the press here, and they asked not to be identified because who knows who holds these bonds, what kind of powerful big banks hold these bonds. And if news comes out who's holding these bonds and they know that they're not going to get their money back, if they have portfolios or if they have hedge funds or if they're banks, well, then their shareholders are not going to be happy at all. So I'll just take a quick swig of water here. So property values are dropping in Europe. Again, this is happening in the US, Australia, etc. as well, as rising interest rates put off buyers until a clearer picture about how far rates will rise emerges. That's right, everyone. They keep saying, oh, don't worry, we'll just do another 25 basis point hikes. Okay, just another 50. Well, every single month, interest rate hike expectations are going up. Nobody thought that in 2022, at the start of the year, that we would be at near 5% interest rates now in the US, or even in Australia over 3%. Nobody thought, thanks for joining Rich Clark, for joining the channel. Thanks for your support there. Nobody thought would be in this situation. And nobody thinks now that will go above 6% or 7%. And nobody even wants to thinking about what if inflation gets out of control? What if we have to go to 10%? Okay, we still have so much uncertainties right now. That's led to wide gaps between bids and offers, crippling deal volumes and putting pressure on owners with loans that are maturing. About a third of all loans in commercial mortgage-backed securities maturing in 2023 and 2024 face high refinancing risk, according to a study published by Scope Ratings in January. Wow, everyone, this is crazy. In 2023 and 2024, you're going to see a bunch of these commercial mortgage-backed securities maturing, and now all these landlords, they're going to go from 2-3% interest rates to 6 or 7. And like I was talking about, investing in real estate with the yields you're getting right now compared to what you can get with bonds, it doesn't make sense. I know yields are a bit high in commercial real estate, but still the yields are very low compared to what they've normally been. And now with mortgage rates or interest rates sky high, your financing costs are a lot higher. So the math just simply doesn't make sense. You can get a better return just putting your money in a bond or just putting your money in a bank account. So why take the risk and hassle of having to manage a property, deal with all the maintenance, when you can just put your money in a term deposit or a bond and do nothing? So concerns about how far values could fall are encouraging lenders to push for sales more quickly, while borrowers would prefer more time to seek higher offers for their properties. Another big thing here happening, everyone. Values are dropping right now, and so lenders, pretty much what they're doing is they're telling them, sell now. Lenders want their money now because they know prices are going to have to fall. Again, simple math, with yields going up, new people coming to buy these buildings, it doesn't make sense for them. They're offering them huge discounts. So lenders are pretty much doing 4 sales here. There's kind of like a margin call on stock where, you take out a 70% loan on your portfolio, okay, then that loan to value drops and you have to sell some stock in order to bring that loan to value ratio back up. This is what we're seeing now in the commercial real estate sector. The banks are feeling very uneasy, and borrowers are saying, look, we need more time because the offers we're getting now are bad. And the banks are saying, well, look, that's your issue, not our issue. So the drop in prices has so far not led to widespread credit losses. So some creditors are betting that rapid sales can still ensure debt is fully repaid. That's right, but that clock is ticking because those prices are falling every month. So this debt relates to a small portion of the Sponder portfolio. A Blackstone representative said in an email statement, "We're disappointed that the servicer has not advanced our proposal, which reflects our best efforts, and we believe we would deliver the best outcome for note holders. We continue to have full confidence in the Sponder portfolio and its management team, whose priority remains delivering high quality retail and office assets." So again, they're saying, look, this is just a small part of our portfolio, but again, every single day we're seeing another property default. We're seeing another commercial mortgage-backed security default. And this is just the beginning, everyone. Like they'll say at the start, 2008, okay, maybe a few people, are doing some foreclosure on their homes, nothing to worry about, but that's just the beginning, and it creates domino effects, and it gets rapidly worse. So we have to pay attention to the signs, because you always get early signs. So Nordic real estate has been at the forefront of Europe's real estate correction after a long period of relative calm following the global financial crisis. That's right. So a lot of these places in Europe still haven't recovered from the financial crisis, and I think this is going to be coming to the US and Australia soon. So investors have been spooked by the landlord's use of relatively short-term debt. Again, exact same thing what happened in 2008, which has made them more vulnerable to the rising rates. The level of cross-ownership in the sector, where multiple real estate companies own stakes in one another, has also exacerbated concerns. Let that sink in, everyone. I want to take a swig of water there. So I don't know about you, but this has given me deja vu to what happened in 2008. Short-term debt, which has led people to be vulnerable to high interest rates, cross-ownership in the sector. So again, we have that contagion effect, and this is giving big concerns for the commercial real estate sector. So in the US, where valuation declines have been more severe and rates have been high for longer, owners such as Pacific Investment Management Co., like I was talking about earlier, Columbia Property Trust, and Brookfield Corp have also defaulted on mortgages. So again, it's not just this one. This is happening to hedge funds in the US as well. Or Blackstone is in the US, I should say, commercial properties in the US. The US office market has been particularly hit hard by the pandemic-induced shift to home working. That's another thing, everyone. We're not going to see this shift all of a sudden U-turn. Yes, we have seen a lot of people return to the office since the pandemic, but we still have a lot of hybrid working. And when technology keeps getting better, when people's internet keeps getting better, really what we got to worry about is artificial intelligence. When that gets better, we're going to have a lot of people be able to work from home, and they're not going to need this commercial office space, and so that's going to be more downward pressure on commercial real estate. So Blackstone's notes have now matured and have not been repaid, prompting loan servicer Mount Steer to determine a default. So that's right, everyone. They've matured. They're not paying. According to a statement on Thursday, the loan will now be transferred to a special servicer, it added. And FinTech downgraded the notes in December, saying that the weak macroeconomic outlook and limited appetite for lending against secondary quality illiquid assets create significant challenges for refinancing. So again, we get signs of this. We get signs of this months before it happens. I try to put out these warning signs, but people want something to happen the next day. They want, real estate to crash 80% in one day. Otherwise, you just fear-mongering. There's nothing coming. The loan was originated by Citigroup Inc. Look, this is how it has contagion effects around. These are the banks that have been lending to this Blackstone. So the loan was originated by Citigroup Inc. and Morgan Stanley and is secured against 45 properties in Finland, most of which are offices at the time of the downgrade, which is 271 million of the senior loan remained outstanding according to Fitch. So we see here how they default on one property. This affects the banks. Investors have shares in the banks. That affects the investors. That affects the bondholders. They're not going to get their money back. So we can see how quickly this has dominoes throughout the whole financial system. So the portfolio is about 45% vacant, having risen about 10% points higher during the pandemic. According to a report, travel restrictions then hampered Blackstone's sales efforts before the war in Ukraine unleashed a fresh wave of volatility. That's crazy, around 45% vacancy. And I know there's more and more office buildings in the US, Australia, around Europe, etc., that have huge vacancy rates as well, but they haven't defaulted yet. But with values falling so much, they may just simply choose to walk away. So again, what this simply means is these commercial landlords did something very, very silly. And unfortunately, what I learned from history is we don't learn from history. They're doing the same mistakes they did in 2008. Everybody thought interest rates would go to zero, stay there forever. But then what the markets got was a shock of inflation. We all saw it coming. We saw when they increased the money supply so rapidly, there was going to be inflation, okay? And so now this has caught a lot of people swimming naked. They've been exposed for the huge leverage they're taking on, and this is something we're definitely going to have to watch. This is something that I'm definitely watching, and what I think is the most important on my radar for the financial system, what could cause another financial crisis. But what do you guys think? Let me know. I hope I have enough water. I need to work on my vocals. Fearless drop. The banks don't let you sell unless you sell what you owe. Or they think, for example, the property is underwater, they might not get all their money back, but if they think, okay, well, if we wait, try to give more time, maybe the property portfolio will fall another 20% and they'll get even less. So banks do take losses. That's why they sell a lot of debt off to debt collectors at a loss. You says buy gold and silver. Stop drinking water, it's bad for you, Pete. Peter says. John Doe said he could sell, but then what? Well, it all depends on your circumstance. If you don't need to sell, there's no reason to sell. Only if you're in a bad situation like these landlords. And we're talking about commercial real estate here. Visible, could we see 50% house price drop? I doubt 50%. I'm thinking more 20 to 30%. Again, that's just average US and Australia. Some markets will do better, some will do worse. Okay. Now, for my Australian viewers, let's now go into a quick update with what's happening with the Australian housing market. And again, for all my viewers in the US, you can relate this to your market as well, because I'll quickly do a brief update what's happening with the US. For the first time, year over year, house prices are falling. We know they have been falling, but they've been falling from their peak. And so with year over year effects, they were still showing a slight gain. But now for the first time since 2012, our house prices are falling in the US. But let's quickly just go over the Australian housing market. So house price fall eased in February, with Sydney posting a rise as real estate listings dry up. Now, again, prices just don't fall straight down. We're going to see some volatility. But even the market analysts are saying here, this could just be the calm before the storm. So if we break it down state by state, Sydney went up 0.3%. And the reason why that is, they've had the biggest annual declines. So maybe people are thinking this is a bargain because prices have dropped 13.4%. They think, okay, it's time to buy the dip. It's time to get in. But there's going to be a wave of properties come to the market when these fixed rate, just like what's happening with the commercial real estate sector, a lot of people are going to go from fixed rates of 2% to variable rates of 6%. And they're simply not going to be able to afford it. And there's going to be a huge amount of listings put up in the spring, I think. Melbourne, everywhere else is still falling though. So Melbourne down 0.4%, Brisbane down 0.4%, Adelaide down 0.2%. This is just month over month, by the way. Perth, pretty much flat, down 0.1%. But the biggest drop was Hobart, down 1.4%. And Darwin down 0.3%. Canberra down 0.5%. But a new shift we're seeing here is before the combined capitals, so the cities were falling faster than the regional sector. But the combined regionals are now falling faster than combined capitals. So with the housing market, it moves in cycles. Sometimes the cities rise and then they cool off and then the regions rise, etc. So it all moves within ripple effects in the cycles. So combined capitals fell 0.1%, combined regional fell 0.3%. And the reason for that is low inventory, which is about to change. And also it's a short month this month in February. So the past 4 weeks have seen the flow of new capital city listings tracking down 17% lower than a year ago and 11.9% below the previous 5-year average. But he says here, this is the people putting out this data. Normally these people are quite pro-property. They're quite, they want to pump it up. But even they're admitting this could be short-lived. While the pace of property price declines has eased in recent months, CoreLogic has posed the question of whether this is the bottom of the cycle or an eye of the storm. Mr. Lawler said the prospect of further interest rate rises, weaker economic conditions, and a rise in unemployment over the coming months all threaten to cause another down leg in property prices. So it's right, everyone, just like what's happening in commercial real estate. We're going to see a huge jump for 800,000 people with a fixed rate cliff. And also unemployment is now rising in Australia, unlike the US, because a lot of mortgages are variable. So these interest rate rises hit homeowners a lot quicker than in the US. So like I said, the fixed rate cliff refers to the reset of around 800,000 home loans this year, with many borrowers going from sub 2% fixed interest rates taken out during the pandemic to a variable rate of around 6% or even higher. So that's absolutely insane, everyone. You're going to have people where their mortgage rate increases by about $1,500 per month, and simply a lot of people aren't going to be able to afford this. So other indicators remain broadly negative, Buyer sentiment near cycle lows, price expectations subdued, risk aversion elevated, and labour market confidence softening, observed Westpac economists in the latest housing market report. So that's right, everyone. A lot of people, they're expecting more declines coming, so they're going to be waiting on the sidelines, and you're not going to see these huge, people paying over asking price. So how far could they fall peak to trough? So AMP chief economist Shane Oliver agreed the market was only halfway to what he expected to be a roughly 15 to 20% peak to trough fall, which would be the biggest in recent decades. That's crazy, everyone. 15 to 20% drop peak to trough. And remember, this is the average across Australia. You'll have some areas do worse, like Sydney and Melbourne, I think, which go forward 25 to 30%. It's possible. Sorry. Really losing my voice here. I think I have to wrap it up after this. It's possible that he's starting. Ugh, not doing too good, everyone. It's possible that this is. You know what, everyone? I'm going to have to do an individual video on this because my voice is not doing good. So I'll go ahead and do an individual video on this, and I'll talk to you